Hi, Steve Van Metre here, and welcome to your Monday night premiere, where we take about 15 minutes every Monday and Wednesday night to try to make sense of markets. Don't make a whole lot of sense. Now, for my astute viewers, you're probably noticing, why are you wearing the same dress shirt you're wearing Friday? Well, because I took my wife down to her 6-month surgical post-op this morning down to Los Angeles. And the good news is everything is going good. She, still healing. It's just when you have an invasive surgery as she did, it just takes time. But the good news is everything's going as well as it can be. And so we're very happy to hear that. She will need another surgery on her neck, and we looked at that, but not for a few years, hopefully. And maybe with some more physical therapy, she can postpone it for a while, but it'll have to happen. Just fortunately, not today. And I think as she's listening to this, she's probably nodding her head and going, yeah, I don't want to go through that again. Let's get the disclosures out of the way. The content of this video is provided as educational information only. It's not intended to provide investor and other advice. This trail is not to be construed as recommendation or solicitation by selling a security, financial instrument, or to participate in a particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in the video that I do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial. All right, let's see what we've got going on in the markets today. Not much. The reason I'm looking down, I got a slide I want to load up for you to see. So not much happening. Quiet day ahead of the ECB, European Central Bank, getting ready to have their meeting where they're widely expected to cut their equivalent of the federal funds rate by 0.1% and resume quantitative easing. And I think the meeting is this week. And then the Bank of Japan also has a meeting. They're expected to cut. And of course, that puts pressure on the Fed to cut. Great news for bondholders. But of course, the bond market today is not a friend of a bond owner, but that's okay. What happens when you get a big rise in price? Let's see if I can do this correctly for your screen, like that. You get some weak players that come in at the end, and they'll throw their money in like, this thing's taking off. Well, I'll jump in. And so what the big players do is they will put a break to that and then drop the price back down. They'll come in and sell, even their own positions. They'll sell down just to flush those weak hands out. And then they'll come back in and buy. So we'll take a look at that momentarily. So with that, like I said, not a whole lot going on in the markets today. But what I do want to look at, and again, my screen is not working. The program has still got a glitch. I looked online, and the answer was, well, we don't know. Looking at the NASDAQ McClellan Summation Index, even though markets price-wise are trying to make a run back at their all-time high, liquidity is still weak. It's still fighting to move higher. It doesn't have a lot of traction, and it's odd that Ken Fisher is sitting here staring at me twice, but nevertheless, we can see that moving higher. Let's take a look at the positioning of the hedge fund managers, which is kind of our big look on Mondays, because there's some still interesting stuff going on here. Look at 10-year Treasury yields, which, again, are back near their all-time lows. And hedge funds this last week increased their short positions. And you can tell by the trading action today that they're going to continue to increase this. So for those who may have missed the big move in bonds and think that there's not going to be another one, there is going to be one, because bonds never bottom when the hedge fund managers are short. They need to go long in order for the bond market to bottom. So yields have a lot more to go, a lot further to drop. And the fact that they're still shorting is excellent news for us, since we're obviously positioned on the other side of that. Looking at the long bond, they got aggressive there too, increasing their shorts. And again, this isn't the total short position. This is just the hedge fund managers. So this is, or what are referred to as market speculators. So this is excellent news for anyone who says that yields cannot go lower. Tell me how these people, these hedge fund managers who are always on the wrong side of the trade in the end, are right this time. They're not. Looking at oil, just an incredible amount of long speculation on oil. Everybody thinks oil is going back 70, 80 plus a barrel. Due to supply cuts and some things, because Saudi Arabia wants prices up. Look, there's a really simple thing about oil. If you cut production, what else do you cut with that? Jobs. The economy is so tightly linked to oil. You can't just, hey, you know what, we'll just cut production, say 50%. Now, I'm not saying anyone has cut any production by any official numbers. If they have, I'm just making this up. So let's say we're going to cut 50%. Are you going to keep all these people employed? Are you going to keep running all the services and jobs and crews? No, you're going to cut them too. And when they get cut and their spending in the economy drops, guess what happens to the whole economy? People have this dream that you can have a recession and still have $90 a barrel, $100 a barrel oil. Yeah, I don't think so. It doesn't quite work that way, but the market believes that right now. So oil prices were up today. We might look at that on hopes that, again, oil is going higher. Maybe there'll be a trade deal. Who knows? As the S&P 500 went up, speculators backed off their long positions a little bit. Gold is in an extreme position. In fact, let's just go look at that now. Where is it? Here we go. So people think, oh, we missed the gold move. No, not even close. This is a great post that was by Andy Smith. I don't even know him. It just showed up on my Twitter feed this weekend, and I immediately had to grab this because it was so important to look at. So he's got 10-year averages, 3-year high and lows, 26-week averages, and all the position. He tracks this thing every week. So he says, look at the gold commitment of traders' commercial positioning. Okay. Now at 10-year extremes. So looking at the most recent one, which would be right here, 485,000 short positions. Now, commercial, you can rename this the smart money as 485,000 short positions. 10-year high, 485,000 short positions. So they are at their max short that they've been. I mean, this is cool. I mean, they've never been more short in 10 years than now. So he says, and open interest. All right, let's go to open interest. Let's see. Oh, open interest is over here. Open interest, boom. And he's saying that, let's see. Open interest is also close to 10-year extremes. Here, open interest, 652,000 contracts. And here you have currently 634 contracts. So the amount of betting is outrageously high, and the positioning is outrageously high. Now look at the non-commercial. Let's see. Oh, here. Also notice how non-commercials have added again to their longs. So here they're at from 365,000 contracts. Their 10-year high long, 389. So he says they chase the trends, which we know, and are wrong at turns. Gold is going to collapse in his opinion. And I believe his opinion is actually warranted on this. So let's make sure you're seeing what I'm seeing. Okay, so this should roll over, pull way back down. That will be the point where you get all the speculator and hot money and retail money flushed out. That's where the smart money lies. That's where we want to get in, because then you get the next big move from gold. Let's see. Hedge-Fund manager is still relatively long on the NASDAQ, not at extreme levels, and are backing off their short positions on the Russell 2000. And they're still fairly flat on the dollar, and as the dollar is expected to rise, and volatility, they, as I expected, are increasing their short positions, and I suspect they'll continue to increase their short positions based on where volatility is at this week. So let's get this straightened out so you're not looking at a bunch of weird stuff. Okay, yeah, you're looking at me. I know that's kind of weird, but that's all right. Let's go to the charts. That's what we're looking at. Great. S&P 500 trying to make a run to its all-time highs. Market is back, being very bullish. Investors are very much thinking, when you look, how do you know? You kind of just look online and see what people are talking about. S&P at 3,000, 3,050. Everyone's talking higher prices. Let me just end this notion that we are, in fact, let's go back to the chart. Over the weekend, I kept hearing all these people say, look at this chart. I've never seen this in my whole career and in 50 years of trading or whatever. This tells me the stock prices are going to go boom, straight up. Okay, so let's dispel that myth real quick. Now think back to Friday's update. Who has been the buyer of stocks in the last 10 years? Now think about it. You've got corporations, foreign investors, institutional money managers, and retail investors. Well, it wasn't retail, wasn't institutional, they're net sellers. Foreigners, not so much because they're turning back into net. They're still positive, but they're rolling down into net sellers. It's corporations. So corporations have been the buyer of stocks. Now, who has been selling? Let's go back to the chart. Who has been selling? See who's really grasped these videos. Who has been selling through here? Who? If you said it was the corporate executives or the smart money, you're correct. Now let's put this into perspective. If I'm the CEO of a Fortune 500 company and I'm saying we're going to buy our stock back, okay, go call Goldman Sachs and buy our stock back, or whomever. Call them and tell them we've got $10 billion, we want to buy our stock back. And then I call my personal broker, hey, buddy over at Goldman Sachs, guess what? I just made an executive decision that we're going to be buying a bunch of stock back. Now, when that happens, I want you to start selling off my 500 million worth of shares or whatever I've got, okay? Why would I sell my stock? Now, think about this. Why would I call and sell my stock if I thought prices might go up 10, 15, 20, 25% because I was still going to direct my company to buy the stock back? Get it? There's a reason these corporate share buybacks are where the market ends, because the guys that are selling, they also decide when the buybacks end. All these people that say that the market's going higher, well, that means the corporations have to keep buying. They have to keep buying. And why would they if the big guys are selling? They're selling to the tune of $600 million worth of shares a day. While their companies are buying $2 billion worth of shares per day. Going back to volatility, why I think the market is going to try to make a run higher. I don't know how successful it'll be, but volatility broke support. We looked at this on Friday. I thought it might. The next level of support is down here. Again, this is the volatility ETF that you will never buy, sell, long, short, doing anything with ever. Do not consider doing that unless you want to lose your money. That's what it says in the prospectus, so you should adhere to that. It tells me that this is going to come down, and I should have closed my email program. There we go. Let's look at 10-year Treasury yields backing up. Not surprised. I kind of said that this thing's going to try to get up here. It's going to run into a lot of resistance, but the market's going to let those who want to sell these positions to do it because they want to load up on bonds going into this next Fed meeting, and I don't blame them. 30-year yields are fighting against their overhead resistance at 2.1, whereas 10-year kind of broke through 1.6 and are now suggesting to run at 1.7. But notice the 50-day moving average coming down pretty quick here. Same with 30-year yields. Let's see these back up to 2.2, which would be fine with me because that'd be a great point to rebalance the portfolios. Look at the 50-day moving average. It's coming down pretty quick. If we look at the bond position, looking at short-term bonds, we currently hold this, but this will be rebalanced out of the portfolio. As you can see, it's coming up at a major level of support, right where these two purple lines are. This is a supply zone, so buyers and sellers have been sitting in here, and the 50-day moving average is right below it. So this has been acting as support. If we look at the long bond, we can see this dotted or orange line is the prior all-time price high going back, I'll say 2015, 2016, and we see it coming down. And I said, hey, it wouldn't surprise me if this thing gets down to 140, and it's looking like it's going to flush out some of these weak hands here. But notice how the 50-day moving average is rising. If you go back, and you may recall if you've watched these videos for a while, this has never been, or the long bond is not confirmed as 50-day moving average. So, well, wait a minute, I see it right there and there. This happened after this price moved up, and then the 50-day kind of just fell right into place. So we have not actually had an official confirmation of the 50-day moving average, which could come very, very soon. So that's good news for long bonds. Let's take a look at emerging markets. What's our time left? In 1 minute. Emerging markets, big proxy of liquidity running into this 200-day moving average, 100-day moving average, and just crossed its 50. The 50 isn't as critical for it as the 100 and 200-day. So if this rejects here and heads back down, it kind of tells you this market rally is over. Gold kind of headed down today, but the big move was in the mining stocks, as I suggested it would be. You can see these things. The large gold miners broke their 50-day, should send it down to its 100-day here. Silver miners, they broke support here. That should bring it down. Junior miners, where we're interested, this is a very clear topping pattern coming into support. We'll see if it holds here. It won't, and probably won't, because when you look at that commitment to trader stuff, it kind of tells you, like, why would you want to get in this game when you have the largest short position by the smart money and maybe the second largest long position by the hot money or the dumb money? Why would you do that? You wouldn't. You want to let this play out. You know who's going to win this game, the smart money, because when you're short, right, and you're long right now, and you see all the short positions you sell, well, all of a sudden that just adds to the shorts. That's why that you get these big fast moves down, and why we're waiting on that, because that's where the position or the opportunity is when all the speculators are flushed out. Now, what we're looking to do is add Z-RAs, the 25 plus year zero coupons to the portfolio. Notice again, their support's down here. Here's their 50-day. So again, could this thing come pop down to here? Grab the 50-day and run? Absolutely, especially again because the Fed is very, very likely to cut. Real quick of note, when the ag commodities move down and have a quick reversal like that, like it did today, there's a very bullish sign when you have, something that's been selling, to see buyers step in and really put a thrust up into the price action. Good sign there. Crude oil is still within its symmetrical triangle, looking to get higher. I just don't buy the narrative that oil should be at $70 to $80 a barrel. Let's close out with Apple. We're running a little bit over. Sorry about that, but it's sitting in its supply zone. And again, Apple's been the market leader, and it keeps getting rejected here. It needs to get over 215 and run, or you're looking at a bigger sell-off. I'm Steve Van Metre. I'll see you Wednesday. Bye now.